Hi, this is Akshay Shrimanka, CPA from Shea CPA. We help early stage founders and technology startups with their tax compliance and accounting. I thought I'd record this video to explain the Paycheck Protection Program as it pertains in particular with early stage tech founders. I've seen a lot of content out on YouTube and in other from other sources that sort of talk about the program generally, but I wanted to record this specifically for the nuances that tech founders are going through. I think to begin, one of the first things that founders are seeing is just the ethical debate of whether venture-backed startups should be taking the stimulus money. So I think founders need to discuss this with their boards and their fellow co-founders, whether whether they're in a position to even be able to make that decision, right? To forego being applying for something that you may qualify for. So, once you get past this point, I think it's a decision that needs to be made pretty quickly because, as the funds that have just passed the Senate, out of the funds that passed, 310 billion for the second stimulus has been earmarked to the Paycheck Protection Program. Out of that, 60 billion has been allocated to community banks in particular in small and mid-sized businesses. So, once you as a founder or your co-founders have made the decision to apply for the Paycheck Protection Program, I think you want to take a look at the rules and see whether you even qualify. And something in particular that's very pertinent for early stage tech founders to consider is the affiliation rules. So I was just going to bring that up uh, quickly here. So the SBA has a guide on their website, which is this small business compliance guide, size and affiliation. And this is sort of the rules that the SBA is following when it comes to the Paycheck Protection Program to see whether your company is the right size, and also if you're falling afoul of the affiliation rules. So with affiliation in general, it exists when one business controls or has the power to control another, or when a third party or parties control or has power to control both businesses. And control may arise through ownership, management, or other relationships or interactions between parties. So they show an example here of a company having power over another company. But for early stage tech founders, at this point you may have raised money through simple agreements for future equity or safes, as they're known, or convertible notes. And as part of being part of this program, you need to take into account as if those have converted to actually calculate who owns how much of the company and what is the degree of control that a shareholder may have, even if they're a minority shareholder owning less than 50%. So the Treasury has released some guidance, and they have said, first of all, through their FAQ, which is getting updated on a day, pretty much every other day, they're updating this FAQ. But with this current update, which is current as of yesterday, April 23rd, 2020, it's still the rule. The general rule is you have to have less than 500 employees. There are exceptions for certain companies, mostly in the food and hospitality sector. And when it comes to affiliation, yes, they do. You do need to be following the rules as sort of laid out by the SBA. One thing that they did sort of clear up is that if a minority shareholder in a business irrevocably waives or relinquishes any existing rights specified in 13 CFR, the minority shareholder would no longer be an affiliate of the business, assuming no other relationship that triggers the affiliation rules. So the SBA is saying here that if the minority shareholder sort of relinquishes those rights, that you may now be eligible for the Paycheck Protection Program. So what I'm advising my clients is to have a conversation with general counsel, and you may need to make some amendments or changes to your bylaws or to your stock holder agreements, especially for these shareholders. So it is a conversation that general counsel, you, the management team, and the board needs to have before you apply for this Paycheck Protection Program, just to make sure that you're fully on side. Um, so I think once you get past the ethical part, once you get past the affiliation rules, and if and now that you're ready to apply, I just wanted to walk through some of the mechanics. First of all, this page, this home.treasury.gov page, it's through the Treasury website. There's a link to it. If you go to the homepage for Treasury, it's like this red bar at the top. They have a shortcut for it right now. And if you scroll down here, you'll see different PDFs with guidance and then a date next to it, which sort of shows the updated date. So you can see frequently asked questions. Looks like they've even updated it today. So, every day they're sort of, I wouldn't say making up the rules as they go along, but they are updating things constantly for probably to drive us CPAs crazy and small business owners. But this is probably the place you want to come and check to make sure that the rules as you know them are still the rules. But as of this sort of recording, the basic process is to complete a borrower application form. Now, you need to do this with your financial institution, so your bank. Many early stage founders, you may be banking with Silicon Valley Bank or another Mercury or another startup sort of friendly bank, or you may be with more of a traditional one like Bank of America or Chase, Citibank, etc. So each bank has its own web portal where you go and log in and sort of complete this application process. And as you can see from what the Treasury have provided here, it's basically 2 pages and then 2 pages of instruction. I guess one page here with 2 pages of instructions and 2 pages where you actually fill in. And for many early stage tech founders, you're going to be checking off that you're a C Corp. You're going to be providing some basic information here, and then doing the calculations of the actual average monthly payroll. So I wanted to get into some of the mechanics there. So we created this Google sheet here to sort of run through an example of what you may be eligible for. So in this example, this company has gross payroll of 707,000. 1099s and contractors don't qualify. So, your accountant won't qualify, your lawyers won't be qualifying for this. Any folks you're paying through Upwork or any developers aren't going to qualify that are like paid overseas, for instance, right? The salaries are capped at 100K. So especially for you executive officers, CEO, the C-suite, who may be receiving more than 100K, you're going to have to cap your salary at 100K. So in this calculation, we're deducting the portion of wages in excess of 100K. And now you can also add health insurance into this formula, retirement benefits, the employer portion, vision, dental benefits, and state unemployment insurance. So once we add that up, here we come to a total of 656, and we divide that by 12. And what we come up with here is what they call average monthly payroll. And this is sort of the number that you would be putting on this application, your average monthly payroll. That's then multiplied by 2.5, and that's going to give you the loan amount that you qualify for. So you see in this case, this company qualifies for a loan of 136,000. And this is not a small amount of money, and especially for early stage tech founders, you guys are thinking about your runway. Depending on when you last raised capital, what I'm telling my clients is you really need to find a way to make it to the other side of this, right? And have enough runway. And having this Paycheck Protection Program sort of gives you leverage, right? Because at the next round, if you're forced to raise at a lower valuation because you're sort of in a more desperate state, that's going to be a problem, right? So I think applying for this program definitely can give founders leverage over, over the next fundraising cycle, essentially, right? And yeah, once you've calculated this number, just going back to this application, the other thing that you're also going to have to provide um, on the application is the number of employees. And the great thing is, for many of you early stage tech companies, you're using services like Gusto, JustWorks, TriNet, or you may be using more of a traditional service like ADP or Paychecks. A lot of these companies are coming out with reports to help you calculate these numbers. However, I still would advise to sort of put this calculation together in Excel as well, which will make this whole this whole process clearer, right? So when you upload this as an attachment, the loan officer, the underwriter on the other end at your financial institution doesn't have to go through a mountain of paperwork to figure out your numbers. But I'm going to bring up here something that Gusto, for instance, uh, is producing for its clients, and you can see here it's telling you the number of jobs, your average monthly payroll, and showing actions. So this is a document that anyone who uses Gusto should be able to get. And then the one other thing they just consider here, right, is that um, for instance, this report is for 2019, but you can actually do this for the last 12 months or even for the first 2 months of the year. So some of you early stage tech companies may have raised money at the end of last year or maybe earlier this year, right? Right before this crisis hit. And you may have ramped up your payroll. So for you to use 2019 payroll numbers, you're coming back to this calculation, your calculation may be higher if you were to go by the last 12 months instead of using calendar year 2019. I think if you can use calendar year 2019, because all these numbers will tie out to this other supporting documents that you'll be providing, such as payroll forms. And then just to go back to the FAQ, I know some of you are also using PEOs like JustWorks, TriNet. There is guidance, again, in the FAQ that says that, if your eligible borrower is using a third-party service such as a PEO, the PEO services now are also putting out some letters and some um, paycheck calculations, because these PEOs aren't going to be able to have provide Form 941, Form W3, which are some tax forms that will need to be attached to the document. So in lieu of those, the PEO companies are coming up with some documentation that you could provide to prove that that you've paid out your employees. So yeah, I just wanted to emphasize the point that it's really important to look at, whether you're looking at calendar year 2019 or if you're looking at last 12 months, which I believe I think it's like April 1st to March 31st, April 1st of 2019 to March 31st of 2020. Or if you're a new business, you can use the first 2 months of 2020. So January 1st, 2020 to February 29th, 2020. So, look at those calculations to see, which one is going to give you the highest benefit, depending on where, when you started your company, right? So, yeah, so just wanted to go over that. Also wanted to, the biggest part of this loan, the biggest appeal is that it's forgivable. It's a forgivable loan. And there is like a formula to calculate the forgiveness, which is based on number of employees that you sort of retained. This is something I think that we got from Thomson Reuters through another colleague. But you basically need to keep your staffing levels as they are for 8 weeks from loan origination. So if you were to get the loan today on April 24th, right, you would need to essentially keep your employees on the same way for another 8 weeks. And if you do let go of someone in that time, I believe there's a mechanism where if you hire someone else, you can sort of still qualify. So the whole key for this loan is the forgiveness part, and that's something that you're going to want to factor in, right? Because you may borrow 136,000 and spend it and burn it, right? And now if you don't have the correct documentation, it may not be forgivable. So the key here for early stage tech founders is to make sure to sort of continue business as usual, because that's what this loan is for, right? Is to maintain your payroll, pay your rent, and keep things going as they were in normal times, right? And uh, yeah, just to go back to the application, right? So each bank has its own process, but essentially for companies that are using something like Gusto or ADP, you're not on a PO, you're going to be attaching your 940, your quarterly 941s, W3s, and then the actual calculation. So this document here, how I sort of put together the calculation in a simple way. And I put this together in Google Sheets. You could probably download this as a PDF and upload it into the bank's system. So that's something that's going to be important to consider as you upload the documents, because they're going to want to see proof that you have actually had payroll in prior years. And some systems, they are only accepting a limited number of PDFs. So like in this case, I've sort of put together a file where I put together W3, 941, 940 in one file. And the whole point of this is expediency, right? You want to help the person on the other side of this loan application see the numbers as clear as day and approve your loan, because the first loan package for 349 billion for the PPP, I think it supported about 1.6 million small businesses, right? It funded 1.6 million, and now with this new funding, which is slightly less, right? It may fund another 1.5, let's say, right, million businesses, and you want to be one of those 1.5 if you haven't applied already. So um, yeah, so that's going to be one thing that is going to be important. The other thing that you may have to disclose is your annual revenue, and you may need to pull that number either from your 2019 tax return or from QuickBooks or Zero, depending on what accounting system you're using. And then you may also need to disclose the ownership. So sort of going back to the affiliation rules, you're going to have to show at least ownership over 50% of the company. So probably your three or four, let's say, biggest founders, if biggest shareholders. So you want to have your cap table information, and for each person on that cap table that is a manager, a member manager of the company, or an executive, you're going to want their address. Some banks are even requiring uploading driver's licenses. So depending on the bank you go through, there's a different application process, right? I'm also seeing that banks are starting to turn away certain clients. I've seen some emails that Chase have been sending, but just because of the sheer volume they have from the first application go around. But in this round, I think a lot of the fintech companies such as Intuit, PayPal, Cabbage, are sort of getting involved, Lendio. So you may want to look at some alternative sources to see if you qualify. I know even Silicon Valley Bank were sort of going through some teething issues when they initially launched it. But now I'm sure the second go around, it should be a lot smoother for a lot of small businesses to apply. Um, yeah, so I think I've gone through everything I wanted here as far as the Paycheck Protection Program goes. So if you have questions, feel free to sort of leave a comment or shoot me an email. And yeah, I wish everyone good luck and stay safe and stay healthy. Thank you all.